All right, welcome everybody. This is our sort of usually monthly town hall meeting. And today's kind of a special day because we have two special guests with us today. We have JB Walker and George Russell from Franklin Templeton Investments with us. Both of them have known us at Summit for quite some time. JB goes back almost my entire career in the business and been really a good trusted partner of our firm. George, we probably met almost 10 years ago. George is actually a fund manager at Franklin Templeton and is in the equity and growth space. So a really great resource to talk about all the things that are going on in the innovation space, technology, kind of large cap growth area of the marketplace. So I thought it would be fun today for us to just have a conversation, three professionals kicking it around, what's going on in the market, what's going on in the world, and what do we need to be thinking about for 2024. So thank you for joining us today. And I think I'll start it off by just letting JB and George introduce themselves and what it is you do at Franklin, kind of what your specialty is, and feel free to talk a little trash about Summit if appropriate. JB, you want to start us off?
Yeah, why don't I? Well, good afternoon to everybody. And to Nate's point, yeah, we've known each other. Gosh, it's almost 25 years, so it has been a long time.
Yes.
It's been amazing to witness the development and the growth of Summit Financial. I've been in the industry over 30 years, 20 with Franklin Templeton. I'm speaking from my home office in Lafayette, and my job title is Vice President. I'm a market leader. As a market leader with Franklin, I'm basically a consultant for financial professionals in the East Bay, the South Bay, and the Monterey Peninsula. Absolutely love the job that I do. Love working with Summit and the big group in there. We have a big diversified company, and we're frequently asked about our opinions on the market, and certainly called on regularly to support advisors with looking at different solutions that we offer or that competitors offer. But good to see everybody today. And as Nate said, I guess a happy early St. Patrick's Day.
I think some people have started the beer drinking already at noon on Friday.
Yeah, it's 12 o'clock here as well as somewhere.
Yeah. George,
All
welcome. Right. Tell us about you.
I'm George Russell, 25 plus years experience in the business. I've been with Franklin now almost 14 years, all on the growth team. So I work in the Franklin Equity Group. We have 130 billion in assets that we manage, 50 plus professionals running mostly growth strategies. So the types of investments that we are mostly growth and innovation types of investments.
Sounds great. And we appreciate both of you guys taking time for us today. We don't do guests all that often on these, but when we do, it's fun to bring in people that we trust and care about and really have spent time with. Both these guys have been really great for us in that area, and I think they've got a lot that we can share. So I'll kind of just kick it off. We'll do it sort of fireside chat style, throw a question at you, let you guys respond, but maybe just a really generic one first. Just what's your take on the state of the markets right now? Just go anywhere you want to, but so many narratives out there. I'll let you guys define that, and then maybe we'll ask some follow-ups.
Okay, great. Yeah. So state of the market, we've been positive, and now it seems like everybody's positive. So, on this particular question, I would argue that we were positive way more than most. If you go all the way back to last year, our group did not think that we would have a recession. We felt that inflation would continue to come down, that interest rates would kind of be capped relatively soon. And all of that has kind of come to fruition. So I'd say that on the markets, we remain optimistic. It's the same kind of view that we've had now for about 15 or so months since we had that big sell-off in 2022. And I guess we're actually kind of looking out for signs of overexuberance. There are actually some market followers who actually think that this thing is just going to keep going and going and going and going, and actually, might become overvalued at some point. But our view is that the market overall valuations are a little bit high, but in a lot of areas, particularly in technology and in healthcare, earnings should rebound this year. If you have continued sales growth and continued earnings growth, that's pretty good. You can still drive good returns in the overall market. So the framework that we've had over the last, say, 15, 16 months hasn't really changed. Non-recessionary type of environment, inflation slowly moving in the right direction, interest rates supportive in the sense that they shouldn't really go up too much more and hopefully will soon go down. Company fundamentals getting better. So still kind of the same type of positive outlook that has powered the market since the bottom back in 2022.
Since you brought it up, I'll just ask the follow-up, George. The inflation thing, inflation moderated a lot from our high point, right? I think we got to 8, almost 9% there for a minute. We've sort of come down to the 3-ish range and stayed, but would your thought is that it's been surprisingly sticky? Would you have thought it would have fallen further, or is this something more normal? It seemed, obviously, I think the media had everybody thinking inflation was just going to keep going down.
Yeah, so I think our group, we have other parts of our organization. The bond folks really, spend a lot of time working on this. Our group was more, it's heading in the right direction and it's not going to get to 2% anytime soon, right? So there was this narrative, I'd say a few quarters ago, where people were thinking, oh, they got to get it down to 2.5 or 2% before the Fed really does anything. We never really thought that that was going to be the case. We thought it'd be difficult to get down to that particular level. But to have it kind of in the low 3s is kind of where we're expecting. What we're hoping, and this is not say like a 1 quarter, 2 quarter, 3 quarter type of thing. What we're hoping is that this AI revolution that we are anticipating leads to really, really significant productivity enhancement, and that can help continue to push inflation down. We've seen over the long arc that innovation, particularly on the technology side of things, is deflationary. So again, it takes a little bit to play out, right? It's not going to happen in the next week, but our longer term thesis is that that's going to help keep a lid on inflation.
I want to come back to that AI thing because it's a big topic that we talk about with clients all the time. JB, because you see the whole complex at Franklin, maybe George in the growth group and really on that technology side. Do you see different opinions about the inflation movement, or is everybody sort of singing out of the same hymn book there?
I would weigh in with commentary from our fixed income group. And you know this, Nate. Remember, under the Franklin umbrella, we have 20 different specialist investment managers. Of that, 3 of them are devoted to fixed income. Franklin Templeton has a fixed income group. Brandywine has a fixed income group. Western Asset has a fixed income group. I'd say they're all kind of coalesced around the opinion that inflation is in fact coming down. I spoke with one of the managers in there today, and one of the points she made to me was that going from it hit 9% inflation down to 4 was kind of an easy move. Squeezing out that 4 down to 2 is significantly challenging. It's very difficult. And we've had some surprise prints lately. We had that trend, and just recently, the expectation was 3.1. It came in at 3.2, so it's a little hotter than what the market was expecting there. And I think our people think trend-wise it's coming down, but it's going to be a bumpy ride to get to that 2% or thereabout that the Fed wants. And we think about it as well. One of the comments had to do with the Fed's flexibility. The one thing Powell and company don't want to do is they don't want to overcut and then all of a sudden have to come back and raise. And because most of our groups, and I think Marketplace, believe that we're coming to a softer landing in the economy. I mean, think about it, 6, 12, 18 months ago, it was all about coming into a recession. That's not really the consensus now, so they got some flexibility. They have it. Unemployment is still, near historical lows. Unless there's some kind of a change in that, it's going to be a slow ride down to that number.
Yeah, it's interesting take. It's amazing to me how everyone was so convinced recession was inevitable at the end of last year, and then oops, just kidding, everyone was wrong. It didn't happen.
Yeah, even Clearbridge is kind of changing their tune with Anatomy of a Recession. And again, their database, it's not like they're sitting there prognosticating based on fireside chats in conference rooms. They're looking at 12 factors, 12 indicators in the economy, and some of them are turning around. So
for participants on this, Clearbridge is one of the managers at Franklin Templeton, and they have this thing called Anatomy of Recession. It's data driven, and they sort of give people a report of where things are at. So it's been interesting to see them sort of change over the last 6 months as well. Let's go back to AI because it's on everyone's mind, and everyone's probably played around. In fact, I was in a client meeting with some retirees who had never heard of ChatGPT, but they were writing their story for their children. And so we talked about a cool package that kind of helps prompt you with things, but the other part, he was talking about how much he hated writing. I'm like, write it into ChatGPT. and he was blown away at how much it would give him back and he could edit it. And so, even retirees who don't even know what that is are going, "How, that's a pretty cool thing." Could you guys talk about what you see happening with AI? I've got my own thoughts from talking to lots of people, but what does this mean for our world? And as it relates to investing, what does that possibly open up?
Right. Yeah. So I just did a 45-minute presentation on AI on Tuesday. I'm gonna condense it down just a little bit.
Sounds
So
good.
first of all, like, what's our thesis? Our thesis is it's the next big platform, like the PC and like the internet and like cloud and like mobility. It is the next big platform. We say multi-trillion because some of these companies already are worth a couple $1 trillion, but it is the next massive thing in our opinion. We really do have it kind of in the same league as the smartphone and mobility, and the fact that we have over 100 companies at least with worth over $1 billion and some tens and hundreds of $1 billion just based on that the smartphone. So we think it's going to be absolutely massive. The way we're investing in it now is there's 3 layers. There's a hardware layer, so it's the semiconductor companies everybody's heard of. Can't say any names for compliance, but you know who they are, and the companies that make the chips and the companies that design the chips. And then the second layer, of course, are the cloud companies, some of them who advertise on TV, and you've heard those too. And then the top layer is the software layer and the application layer. And the first step there will be the big companies incorporating things like ChatGPT and those types of capabilities into their software, and then upselling customers on that. Just give you a few examples of how we're using it and things we see in the future and the excitement there. The first side is just, for the knowledge worker. Our team has 35 research analysts on the team, and each quarter when a company reports earnings, the analyst has to write a summary report for our portfolio management team. And so what we're doing right now is we'll take an individual analyst and we're feeding a bunch of their previous reports into the AI machine, and we're training it on how the analyst writes. And then when a company reports, what we hope will happen, and we're going to have this in a couple quarters, but what'll happen is the first draft that analyst will write to the portfolio managers will be done by the computer, and then they'll go in, make adjustments, adjust their price target, adjust their model, adjust if we want to buy or sell the stock. But that first 4 hours of work of reading the transcript, listening to the management team, and doing all of that work will be done by the computer. And so we see it as a very big productivity enhancer for the knowledge worker. When you look at like healthcare, on the healthcare space, they're already using it. The top of the funnel for design of pharmaceutical products, drugs, biotech is really large, like tens of thousands of compounds and proteins that kind of start at the top of the funnel. Then after 7 to 10 years of research and trials and all that, you get like 40 or 50 or 55 drugs approved in the US. So they're trying to accelerate the top part of that research to figure out which compounds might end up resulting in pharmaceuticals that could be products down the line. So really interesting things taking place on the healthcare side. Advertising, creative, really a lot of excitement there. The question we get is, what about job losses? There will be some jobs that will shrink. But our view is that for the most part, most AI use cases will be more productivity enhancing as opposed to job destroying. So we are very optimistic. I can dive deeper if you'd like, but I want to make sure that I don't spend 45 minutes talking about this one topic that is the thing we're most excited about in our group.
Yeah, well, I think it's great. And maybe we'll do a separate one of these down the road if feedback from our people is like, I would love to go deep on that, and we could just advertise we're going to dig into AI because it's fascinating, scary, but I think to your point, mostly positive in that the productivity, right? If you could, how much of the busy work could we eliminate? How much more productive could we make our best people? I think every industry, regardless, even stodgy old financial companies, trying to figure out how to use that in a way to save time. So it's very cool. Maybe that's a good way to segue into some themes. I know your group has sort of a thematic investing bent to do. Maybe sharing what those themes are and why you like investing in them might be kind of helpful as people think about their investments going forward.
Excellent, excellent. Yeah, so we think about our themes in terms of the 5 platforms of growth. They're not, they don't cover all of the economy, but they cover a lot of the economy. So the first platform of growth is disruptor commerce. That's basically our take on retail, but it's online shopping, payments, logistics, the whole infrastructure around online shopping is disruptive commerce. Genomic advancements is the second platform of growth. If you ask, people on our team what platform will be the most impactful to individuals, right? All the people on this call, we think it's genomic advancements. Right? AI is going to generate probably the most profitability, but how is it going to impact our lives? We feel as though the combination of advancements on the genomic side of things, as well as the GLP-1s, right? The weight loss drugs, which are also being used for diabetes and possibly can be used for alcoholism and gambling addiction and all sorts of other things. Those two things we think are going to be incredibly impactful over the next decade. Intelligent machines is our third platform of growth, and this is kind of the coming together of artificial intelligence in the physical world. So this is robotics, driverless vehicles, connected devices, those particular types of things. Fourth platform is energy transformation. And so this is not just, electric vehicles and solar and wind and those things. We do see a lot of dollars going into that area from the government, and some people like it, some people don't, but also from the Exxon Mobils and Chevrons of the world that see the writing on the wall and are looking into clean energy solutions. So there's a lot of private money that's also flowing to this, but it is a combination of, say, cleaner energy, but then also how do we make carbon-based energy, oil, natural gas, et cetera, cleaner as well as we kind of make this transition over the next however long it takes, 40 or 50 years. And then the last platform of growth is exponential data, which is our take on technology. So this will be some AI as well, augmented reality, virtual reality, cloud computing, software. So that is a very, very big area. I'd say just from today's investment opportunities, the intelligent machines and exponential data is really where the biggest opportunities lie, because they're both kind of AI related and other data related areas. But our optimism, in terms of, like I said, like helping the people on the call, is with genomics over the next decade. And then some of these areas are small now, like energy transformation, but we're hopeful that they can be quite large over the decades to come.
Yeah, well, kind of in that vein, and Toyota bagged their entire line of electric vehicles, and it seems like everybody is sort of jumping off the bandwagon a little bit on either autonomous driving or all electric. And everybody's been talking in California about how our grid can't support all of those. What's your take on that? Because it's in that theme, but it does seem like a little luster off all of a sudden after it being the thing that was going to happen.
Yes. So when we started this platform of growth about 15 months ago, we swapped it out for a different platform of growth and kind of merged New Finance away. We were thinking a lot about clean energy, and then we did a bunch of research, and we're like, actually, the transition is going to be slow and take a really long time, and a lot of dollars are actually really flowing to like carbon capture and stuff like that, and hydrogen and those particular types of things. And so we haven't found a lot, but we're looking for investments in ways to make, carbon-based energy cleaner. On the EV side, yes, we've definitely seen a slowdown, but the big player in that particular space, which has seen a decline in the stock price recently, has a really big technological edge. It's part of the reason why you're seeing, say, some of these companies reassess their strategy in electric vehicles, is because one company is so far ahead in terms of the battery technology, and they continue to push down pricing that it makes it very uncompetitive. Every EV that one of these other companies sells, they're losing so much money on them. And then one company is making tons of money, and they're like, look, we can continue to push prices down and put pressure on these companies. And then as we kind of, they struggle down the line, maybe kind of take price. And so part of it is just one company being so much more advantaged. I mean, look, I live in Danville and I've been to your offices. We know what the most popular car in our area is. So probably a lot of people on the line actually own these vehicles.
I would
And
definitely say they do.
there's just no comparison in terms of the performance versus, Toyota, whatever, Ford, Porsche, whatever. It's just not even close.
Yeah. And I think, by the way, we can say company names. We're not recommending any of them on here. We're going to refrain from talking about any of the funds that these guys manage because we don't want this to be a solicitation for that. But everyone knows what we're talking about there. It's a little car company out of Fremont that has had their stock price go to the moon and back a couple times.
It's like 20% of the cars in Danville.
Exactly. It's kind of crazy. Maybe just in light of that, because that was one of the Magnificent Seven, like 2023 was the Mag 7 year. The S&P 500 was dominated by those 7 companies, the NASDAQ even more so. As a long-term asset allocator and guy who's trying to run money for generations, I worry anytime something gets that concentrated. As a tech and innovative investor, you're probably, this is the greatest thing ever. It's been good in your space. But I would just love both of your thoughts on the relative concentration for 23. Is that continuing into 24? Do you see it broadening out? And if so, where would be the spots that maybe people aren't thinking of that don't have the headlines?
Yeah. So from our standpoint, given our view that we're in this non-recessionary camp that like most people have kind of come over to what we've been thinking the entire time, we feel as though you're going to see a broadening out of the market. More companies will be participating, right? So when you have a lot of fear, then generally that's not good for the returns of many, many stocks. But if you have some sort of like big tailwind, like AI or something like that, then you can get markets that are doing really, really well, driven by a handful of names, which is basically what happened last year. Late last year, November, December, you started to see more companies outside of the Magnificent Seven participate. Our view is that as people get comfortable that we are not going to be in a recession, then you'll see more companies that do well. And look, small companies don't do well in recessions, and so you don't want to own them. But if the mindset changes on the economy, then that leads to more participation in mid-size and small-size companies. On a longer-term basis, we just wrote a paper on this phenomenon where if you go back to like 1978, the top 10 companies in the United States were an average age of almost 100 years old, and they were all second industrial revolution companies like oil companies and phones and stuff like that. And now 7 of the 10 are third industrial revolution companies that have been based on technology. And our view is that as you go ahead, now this is like more like over time, this is not like the next 6 months or so, but as you go and move into the fourth industrial revolution, then AI and robotics and genomics and a lot of these platforms are going to actually lead to more large companies. We might have 12, we might have 15, 500 billion or more. So we see innovation accelerating, leading to more bigger companies, not necessarily as much concentration maybe, but more large companies. So we have both kind of like a positive and a short-term and long-term view on kind of broadening out of opportunities.
JP, what are you hearing in the world over there on that?
Ditto on the thoughts on a broadening of the equity markets. And if you, again, coalesce the opinions of many of our independent specialist investment managers, it's kind of take a fresher look at things that are down the market cap size, mid cap and small cap. And that ties in with a view that maybe the economy is going to be better. We're not going to go into a recession. The other thing is that we've noticed that a lot of people are pretty underweight their fixed income allocations. And that's for a lot of reasons. One would be, the lashing that everybody took in 2022, during, the bulk of that time when we had 11 rate increases by the Fed, pretty unprecedented with how quickly it went up. So we all know this, stocks and bonds both went down precipitously. People don't recover from stuff like that psychologically overnight. So there's a little bit, actually a lot of bit of an underweight to fixed income. The other reason for that is, with rates having come up for a decade or more, we've lived with very low short-term rates, very low loan rates, just low rates in general, low yields. And right now it's coming off, but people were able to sit comfortably in CDs, money markets, safe stuff, risk-free assets that are paying that magic number of 4 to 5. As and when rates come down, I mean, reinvestment risk is going to rear its head, and we think there are people that are going to be in front of it and people that will be behind it. I think to look back and go, oh wow, bonds really recovered well. They're up 10% or whatever the number is over the trailing 12 months. Why not be there for it? And we see that improvement underway. So under allocation to fixed income generally.
We're actually having those conversations across the board with all our clients. We do this thing where we'll bucket off sections of money, money you're gonna spend in the next 3 years, we just don't wanna take risk with. And for the last 2 years, you've been able to buy treasuries or money markets and beat the pants off of anything else and take no risk. So it was really hard to do something different, but we are, even in our practice now, starting to wean off of that, go back into some fixed income managers where we feel like the downside risk just isn't there as much anymore because they're not going to raise rates to the extent that they did before. So while it could fluctuate in the short run, maybe not so much as it did before. And it is tough to let that go, both for advisors and for clients. And then, of course, when we meet new folks who were scared of 2022, they didn't work with us yet. You might see somebody, we took over a client recently with an all CD portfolio. I haven't seen one of those in a really long time, but I was like, whoa, how long have you had it this way? And it wasn't that long, obviously, the sort of reaction to 2022, we were like, this won't work. This is not a healthy long-term plan. So it's interesting to hear the perspective.
Yeah, there's three key risks with that, with fixed income or being in perceived risk-free assets, money market CDs. We talked about reinvestment risk. Long-term, there's inflation risk because they don't really do anything to help with that. And then we touched on opportunity risk. What am I missing in terms of that recovery? So they need to be thought about and discussed.
Yeah, and we have a bunch of business in the municipal bond space because we're in a high tax state in California. Franklin happens to be a manager that does a lot of work in that area. Maybe JB, if you can talk really briefly about what your municipal bond managers are feeling, maybe the health of those municipalities compared to maybe perception, and then their outlook. And I know some of the managers we've talked to in the past, sort of what are their thoughts these days?
Yeah. So everybody knows what munis do. They pay tax exempt or double tax exempt interest. Their bonds, their bond funds. As you know, Nate, we started the first bond fund in the industry, in the muni bond fund in the industry back in the 1970s. Munis were not immune in 2022 when the market, fixed income went down, stocks went down. They did perform better. They did come back better than taxable bonds in 2023. Very strong recovery at the end of the year. November and December of 2023, when the market became pretty convinced that the Fed was going to ultimately cut rates. The yield curve changed. Long-term rates went from over 5 to under 4%. Huge recovery there, and a lot of it was felt in the muni bond marketplace. We think kind of the next wave there is going to be more people returning to the muni bond, particularly mutual fund asset class. A unique thing about munis is that it's a very retail market. Over 70% of the participants are people like you and I and the clients on the call here. It's a very retail driven asset class. When there are outflows, that typically portends way underperformance. And the inverse happens when the flows come back in. That portends really, really good performance. In 22, in the industry, there was about $150 billion of outflows from munis, a lot from funds. In 2023, it abated. I think by the end of the year, it was outflow of about 20 billion. Year to date, 2024, we're positive. So what is starting here, it's underway, is that as the flows come back in there, that causes spreads to compress. In other words, if you own muni credits that are yielding more than the hypothetical AAA credits that are out there, as people come in to buy that, seeking yield, it drives the price up. It compresses those spreads. We believe that's underway. It's happened, virtually every time in history after difficult and challenging muni performance. So we do a lot of work evaluating appropriate muni credits, and we take advantage of that in all the funds. With regard to municipal health, I know there's a lot of talk out there, particularly in the state of California. We might hear our governor talk about a big structural deficit and here's what we got to do, and there's problems ahead. Keep in mind, California, if you look at it, look at it as a country. If you were to look at it as a country, it's like the 6th or 7th largest economy on the planet. It's very diversified and it will go through economic cycles. But it also, unlike federal governments or, governments around the world, it's got to balance its budget every year. So when they go through a period where there might be a perceived structural deficit, there's things that they can cut. They're still sitting on a pile of rainy day funds that came out of COVID, about $50 billion. The other thing to keep in mind is that they've got to balance the budget, but they also have to pay their debt. So when you think of general obligation credits in the state of California, by constitution, it's the second priority in the state's constitution. Number 1 is to pay public schools. Number 2 is muni bonds. And if you take a look at the overall debt in California as the numerator and the denominator being the GDP, the economy in the state, compare that to like the US economy or economies around the world, it's really, really low. When you look at specific credits that are not direct California general obligations, much of it is based on revenues in different areas: water, sewer, power, transportation issues. So those credits can be judged on their own merits, and they're not going to necessarily be tied in to some of the more macro issues in the state. So we like the asset class right now. And the whole theme here, we're talking about that magic number of 5. That's a taxable number. I know with T-bills where you could have a 5 handle on the yield, you've got a state tax exemption. But that said, double tax-free can look very attractive. And when you compare the yields nominally on munis, then the taxable equivalent yields with other investments out there, perceived risk-free, there's a pretty wide delta. Couple that with some tailwinds that we believe that the muni asset class has right now, we see it as a compelling opportunity.
We appreciate it, and we believe in that too. As everyone on this call knows, you guys all have municipal bonds in your after-tax portfolios. Just one reminder, if you do want a question that you want to add, Joe, use that Q&A button at the bottom of your screen, type a quick question in there. We're getting close to the end here. I don't want to keep you or them terribly long. So sometimes we do this thing called a lightning round. So I'm just going to throw a word or a phrase at you. And then, in 1 or 2 sentences, just hit me with how it hits you really quick. So let me start with economists.
Oh, just our response to the word economist?
I say economist. You say?
Oh, God. Inconsistent.
There you go.
Our group doesn't really follow them. Stock by stock picking.
That's right. Don't pay too much attention. The Federal Reserve, what comes to mind?
Conservative.
Got us into this inflation mess.
Nice. I like that one. It was their fault. Now they have to fix it and clean it up, right?
Something like that. In my opinion, not necessarily politically group.
Hey, get that disclaimer in there, George.
Yes.
That's why it's fun to do. This one's like, no one's talked about this in a while. How about crypto?
Go ahead, George.
I'm 54. We'll never own it.
I never say never to anything, so I will, my one word response is fascinating.
Interesting. This is one that we're all going to deal with over the next few months. How about the election of 2024?
Half of the country will be very mad.
Yep, yeah, election of 2024. Ugly.
Yeah, I think everybody's here for that. Nobody wakes up and goes, "Oh yeah, I'm just rooting for someone." They're almost just like, "I'm just rooting against someone." It's not really. I a great thing. Somebody piped in with a question that we should probably dig a little deeper on, George. Would you define what genomic advancements are? You were really excited about
Yep.
it. I think I assumed, and we should
Yeah.
probably tell everybody what that means.
Yeah, that's yeah, I guess when we created the platforms of growth, right? Instead of saying healthcare, we created these fancy names, right? So, it's everything kind of around whatever gene-based therapies and those types of things. The premise of it is the Human Genome Project took 13 years and $2.3 billion to sequence like one strand of person's genes, right? And now with some of these machines out there, you can do that for under $500. So the more that we know about somebody's individual genetic makeup, then we can down the line either predict what diseases a person might have, or we would be able to have therapies that are more targeted for that particular person, right? So people like, on the call, whatever, you might get cancer or something like that. And based on your genetic makeup, there might be therapies that are better for you. And then someone else has the same exact disease, and based on their genetic makeup, different therapies that are better for them. And then there are some diseases that are gene-based diseases that are really, really bad, like kids who can't really develop muscularly, like really very well at all, and they're very debilitating. And so there already are therapies where you kind of extract the blood from the kid, and then you do some gene editing and put it back in, and then they're not like us, but they're much improved, right? So you can actually change somebody's genetic makeup to improve issues in that area. So there's a lot of different things we're excited about it in that area.
That is just incredible advancements, right? I think I always refer to it as biotech, which is probably a blunt instrument. It's not really what that is, but there's so much that is being discovered. And I mean, how many of us know someone that is fighting cancer and they're progressing at 10 times the rate that someone who fought that same thing 10 years ago was? Like, we're just getting better. It's amazing what's happening. So it's cool that we have an economy that rewards the innovation in that area. So there's money that flows to there, which means we do it faster. And I know it's not perfect, and I know that we get frustrated with it, but we're ahead of everybody in the world doing that stuff. And it's powerful and it's life-changing, and it's pretty neat.
Yeah. There's a lot of excitement that's taking place in that area.
Very cool. All right, final question. $10 million of cash in your hands today. What are you investing in without using your fund name, obviously, but like, what would you do with it for the next 30 years?
Oh, I mean, I'm biased. I would invest in growth and innovation for 30 years. I mean, between everybody on this call, we could probably come up with like 100 scenarios where over the next 3 months or 6 months, the market's down and, whatever, accelerated intensification of war, blah, 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 stuff like that. Over the next 30 years, our group's really competent in innovation. If you have a very long-term time horizon, we think that's the best place to be. But well, I'm also
JB, how
on the
about
growth
you?
team.
Gold
I would,
bullion under the deck.
You extend the time horizon 30 years, and I'm going to be aggressive. I'm going to be very growth oriented. And yes, growth and innovation would make sense. I believe in having dry gunpowder. For me, what I do, dry gunpowder is in tax-free bonds, California tax-free bonds.
Those opportunities. Gentlemen, I appreciate it. We're 40 minutes in, and out of respect for your time and everyone else on here, I'm going to call it here. But I really appreciate you joining us. Been great partners at Summit. It's fun to kick this around with you, and I know our clients enjoyed it too.
And if
Thank you
anybody
very
has
much.
follow-up questions, we're connected very well. So don't hesitate to reach back out with anything, to and through Nate and Cody, and they can get answers from us.
You bet. We'd be happy to do it. Gentlemen, have a great weekend. Happy St. Patrick's Day, everybody.
Thank
Same
you.
to everybody. Thank you.